Four of the world's biggest asset managers just made a move that nobody saw coming. Aberdeen, BlackRock, State Street, and Legal General didn't just dip their toes into crypto, they went all in on Hedera's network. While you were sleeping, HBAR broke through a massive technical pattern and institutional money started flowing like a dam just burst. The price? Already up, but this is just the appetizer. We're talking about a fundamental shift in how trillion-dollar institutions are approaching blockchain technology, and Hedera just became their weapon of choice. Look, I've been tracking institutional adoption for years, and most announcements are just noise. Companies throwing around buzzwords like blockchain integration and digital transformation without actually building anything substantial. But Wednesday's announcement from Archax? This one's different. For those who don't know, Archax isn't some startup operating out of a garage. We're talking about a UK-regulated digital asset exchange with full European permissions, the kind of institutional-grade platform that traditional finance actually trusts. And they just launched something called pool token functionality directly on Hedera's network. Now, before your eyes glaze over thinking this is another boring tokenization story, let me paint the picture of what just happened. These pool tokens aren't just another DeFi experiment. They're creating multi-asset portfolios as single, transferable tokens. Think of it like an ETF, but instead of being locked in traditional banking rails, it lives natively on-chain. The underlying assets? Equity, debt, funds, cryptocurrencies, basically everything institutional investors want to touch, now wrapped up in blockchain technology that actually works at enterprise scale. But the real bomb drop? The first pool token minted on Hedera contains equal parts money market funds from those four asset management giants I mentioned. Aberdeen manages $496 billion. BlackRock, try $10 trillion. State Street oversees $4.1 trillion. Legal General handles $1.3 trillion. Combined, we're looking at over $15 trillion in assets under management, and they just chose Hedera as their blockchain playground. Now, while institutional partnerships are exciting, the market had to respond somehow, and boy did it ever. HBAR price was stuck in what technical analysts call a falling wedge pattern since late July. Picture two converging trend lines squeezing price action tighter and tighter, like a coiled spring building pressure. For months, sellers kept pushing lower highs while buyers defended higher lows. Every crypto trader knows what comes next. Explosive breakouts. Wednesday morning, HBAR punched through that upper resistance line like it was made of paper. The immediate reaction? A 2.69% surge that caught most traders completely off guard. But that initial pop was just the market waking up to what actually happened. Trading at 23 cents as I'm recording this, HBR is sitting in that dangerous zone where anything can happen. The technical setup is textbook bullish. RSI climbing above the neutral 50 level, MACD printing a bullish crossover signal on Tuesday that preceded the breakout. But patterns and indicators only tell part of the story. The real question isn't whether HBAR can maintain this breakout, it's whether the market fully understands what Archax's partnership represents for the entire real-world asset space. Think about this. Most RWA projects are theoretical. They talk about tokenizing real estate or bringing traditional assets on-chain, but they're stuck dealing with regulatory uncertainty and technical limitations. Hedera just skipped the line. While other networks struggle with high fees and slow transaction times that make institutional use cases impossible, Hedera processes transactions for fractions of a penny in seconds. When you're moving money market funds worth billions, those micro fees and instant settlement times aren't nice-to-have features, they're business requirements. The timing couldn't be more perfect either. Traditional finance is desperately looking for yield in a world where money market funds are finally paying decent returns again. Fed rates sitting above 5% means these funds are attractive, but the operational overhead of managing multiple fund positions across different institutions is a nightmare. Pool tokens solve that problem elegantly. Instead of dealing with multiple custodians, multiple settlement systems, and multiple operational headaches, institutions can now manage diversified money market exposure through a single token. Alright, let's talk numbers and realistic price targets because that's probably why you clicked on this video. The immediate technical target is crystal clear, 30.5 cents. That's where HBAR peaked back on July 27th, and it represents roughly a 30% gain from current levels. Given the momentum we're seeing and the institutional catalyst we just discussed, that target looks entirely achievable in the coming weeks, but that's just the beginning of the story. The broader implications of Archax's pool token launch extend far beyond a single price pump. we're witnessing the first real-world deployment of institutional-grade multi-asset tokenization on a network that can actually handle the scale. Remember, this isn't some experimental DeFi protocol hoping to attract retail users. These are regulated financial institutions with fiduciary responsibilities to pension funds, endowments, and sovereign wealth funds. They don't make decisions lightly, and they sure don't choose blockchain networks based on hype cycles. The fact that they chose Hedera over Ethereum, Solana, or any other network tells you everything about where smart money thinks this industry is headed. Low fees, predictable costs, enterprise-grade governance, and regulatory clarity. These aren't sexy talking points for crypto Twitter, but they're exactly what trillion-dollar institutions require. Now let's address the elephant in the room that nobody wants to talk about. HBAR has been one of the most underperformed major cryptocurrencies over the past 2 years. While other networks pumped on speculation and meme coin mania, Hedera quietly built institutional partnerships and enterprise use cases. That methodical approach might have seemed boring during bull market euphoria, but it's exactly what positions HBAR for sustainable long-term growth when institutional adoption becomes the primary driver of crypto valuations. The pool token launch represents proof of concept for a much larger market opportunity. Money market funds are just the starting point. Corporate bonds, real estate investment trusts, commodity baskets, private equity allocations, basically any financial instrument that institutions want to trade more efficiently can potentially be tokenized using this framework. From a risk management perspective, the 200-day EMA at 20.8 cents provides clear downside support. That level roughly coincides with the lower trend line of the falling wedge pattern we just broke out of, creating a logical stop-loss level for traders managing position sizing. But honestly, the risk-reward setup heavily favors the upside here. Institutional partnerships don't get announced every week, and when they involve names like BlackRock and State Street, smart money pays attention. Look, I've covered enough crypto partnerships over the years to know the difference between marketing fluff and genuine business development. What happened with Archax and Hedera this week falls squarely in the latter category. The immediate price target of 30.5 cents represents just the first wave of what could become a much larger institutional adoption cycle. As more traditional finance companies recognize the operational advantages of blockchain-based settlement and portfolio management, networks like Hedera that can deliver enterprise-grade performance will capture disproportionate value. For traders, the technical setup is clear breakout pattern, bullish momentum indicators, and institutional catalyst driving fundamental demand. For investors, the long-term thesis just got significantly stronger with proof that major asset managers are willing to bet real money on Hedera's technology. The real question isn't whether HBAR can reach 30.5 cents. It's whether the market fully understands that Wednesday's announcement represents the beginning of institutional DeFi, not just another crypto partnership. Position sizes accordingly because this story is just getting started. A disclaimer. This content is for educational and entertainment purposes only, and should not be considered financial advice. Cryptocurrency investments are highly volatile and carry significant risk of loss. The information presented here represents my personal analysis and opinions, which may be incorrect. Always conduct your own research and consult with qualified financial advisors before making investment decisions. Past performance does not guarantee future results, and you should never invest more than you can afford to lose.